said that the simplest strategies are the best ones. And to a certain extent, it is quite true. Especially for beginners. That's why I focus a lot of my videos on simple strategies that new traders can implement with ease. So in this video, I will be sharing some easy strategies that can be traded using a simple pin bar candlestick. But before we start, be sure to hit that like button and subscribe to our channel, so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, let's talk about the pin bar candlestick. Most of the traders on YouTube, including me, have shown you hundreds of candlestick formations that you can use in trading. The problem is, it is quite a job to remember all of them. And even more difficult to identify them in real time. So, in this strategy we will be using only one candlestick formation. That is the pin bar candle. This is how the pin bar candle looks. We can see that the pin bar candle closely resembles a hammer. That's why it is also known as a hammer candle. Now, pin bars are strong reversal indicators. Therefore, if we can successfully identify a pin bar candle, we could catch a trend reversal. So, why does the pin bar candle work? Let us understand the logic behind it. So this green candle is a bullish pin bar. Let's say that the price was in a downtrend before this candle. Then on this candle, we see that the price opened here. Then the price went down and created a low at this point. When the price was at this low, there was a sudden change in momentum. The buyers saw this low price as an opportunity. So they started buying the stock in huge quantities. This leads the price to substantially rise and close above its open. We can also see that the candle closed near its highs. If we dive even deep, we can say that the sellers were able to push the price from the open to the low. But the buyers were so strong that they not only covered the ground until the open, but they crossed beyond the open and closed the candle around the highs. So, we can clearly see that the buyers covered more distance than the sellers. Therefore, the buyers overtake the sellers, and we can expect the price to make an up move. The same logic applies to the bearish pin bar. Let us assume that the price made an up move before this pin bar. Then, this candle opened at this price. Due to the previous bullish pressure, the price goes up and creates this high. At this point there was no signs of the sellers. When the price was at this high, the sellers saw this as an opportunity to sell. For some reason or the other, they started shorting the market. The sellers were so powerful that they not only reached the open, but they exceeded and closed the candle near its lows. So they overtook the buyers and displayed their intentions with the pin bar candle. Therefore, we can expect the price to make a down move here. Now, we need to understand one thing here. Every pin bar candle does not lead to a reversal. For instance, here we see that the price was in a strong uptrend. In this uptrend we see a lot of bearish pin bars. If we sold at each of these candles, we would have made huge losses. Hence, we need to take the background information into context, and then look for an opportunity. In other words, we cannot trade solely based on the formation of a pin bar. We need to look for confluence and confirmation.